It's time for Ask the Expert on News Talk 1340 and 96.3 FM, KWLM.
Yeah, thanks for joining us once again for the podcast. Today, Craig Popp is sitting in with us, and whenever Craig comes in, we always talk a little golf to begin with. Craig was one of the movers and shakers to get the Eagle Creek Match Play Tournament going on this summer. I think I was the first one to sign up after you, of course, and we're going to get to play some golf, but in your profession at AccruWealth, it's been interesting the last 6 weeks or so, that's for sure. In your chair, you don't even get a seatbelt when riding the roller coaster, but you've got years of experience in there. There's ways to make money in an up market and a down market, right?
Yeah. And really, I almost think in an environment like this, what we're really trying to not do is lose money. And when I say lose money, it's making decisions that will permanently impair your ability to compound, right? And so what's one of the questions I received, or it hasn't been extremely prevalent, but investing is a very emotional thing, and there's a lot of research around that. I think in our first show we talked about behavioral finance, right? And I think I'm going to come back to that next month because it's probably fitting, but you get the phone call of, well, should I sell before I lose everything? And I know it's an emotional comment, but I also think that's where we start to differentiate between investing versus speculating, right? If you're practicing diversification and risk management, losing everything is extremely low probability. We're not allowed to make guarantees in this business, right? But again, we can just apply math to it. Don't let your emotions drive investment decisions. The last week has been really interesting from I like to say volatility clusters. So when you feel better about things, it's probably too late. Let's go back to the past week. So April 4th, the S&P fell by 6%. That was a Friday. Monday comes, we fell by another 4.5%. It was the worst two-day decline in the third worst two-day decline in the last 30 years. So tough to take. We get to April 9th, we're up 10% on the day. It was the best session since October of 2008. And all we need to do is look at your long-term probability of success by historical data. So I've got some charts here. 5-year holding period. So if we just you start today and we look out 5 years, we start at the end of the month and we look out 5 years. Going back to 1937, that we've had stocks up 90% of the time, 76 periods up, 8 down. We extend our horizon even farther, 10 years. Even if you're retiring today, you have a 10-year horizon. We had 97% of the time, 77 up, 2 down. The 2 down were really kind of that 08 period, because what we had in there was the 01-02 recession and then 08 as well. So you got to kind of look long-term probability of success. I also think a little bit about differentiating between the accumulators and the spenders. So we're accumulators. We should welcome market volatility. It's a chance to buy cheaper.
Right.
The stock market's one of the things people almost don't want to buy when it goes on sale.
Yeah, isn't that strange?
It is. It's very strange, but it's emotional. And then if you're the spenders, you're the individuals in retirement who need money from your portfolio. What's been ironic there is I'm getting calls because we're watching TV. It's very polarizing. You're doing much better than the broader market. And that's because bonds are up year to date. More conservative stocks, the dividend payers, basically through Friday, they were down about half as much as the market. And then non-U.S. companies are actually doing pretty well. So we're seeing portfolios that we've got a market down 8.5%. They could be flat or down to 1%. That type of downside capture is what you want in retirement. I like to call it winning by not losing.
Right. Absolutely. And you are going to have those times. I mean, we've had corrections in the market and bear markets off and on throughout history going back 90 years or so. It isn't that unusual. It seems unusual because it happened quickly, but this has happened before to the market.
Oh yeah, yep. I like to say volatility is the price of admission for long-term compounding. Everybody wants to know now is sort of when will the market bottom. So I'll rub my crystal ball a little bit, but I don't know if anything's going to come out of it, because essentially with market bottoms, we don't know until they're past. And right now, the market's trying to predict the unknowable, and what that is the impact of company earnings, because what you're really buying when you participate in the stock market is residual flow on cash of the business that it produces, and nobody quite knows the impact. So what do we have to do? Let's kind of use some analysis. Fundamentally perspective, okay, We started the year expecting about $280 of earnings per share on the S&P 500. On February 19th, we were at 62.05, kind of implying a 22 times multiple, so basically what you're paying for that dollar's worth of earnings. If you think that's going to hold, current S&P today at 4,900, you're kind of paying 18 times. So we've gotten cheaper. I wouldn't necessarily call that cheap, but reasonable. Now the question is, what happens to earnings? If earnings come down 10%, we're at 250, 4,900, you're paying 20 times. That's okay.
Yeah.
Again, not cheap, but nobody knows what earnings are going to do from that perspective. So maybe we just need to look out a couple more years. We know things are going to grow. What I think is also fascinating in this environment is the technical side of things. So very statistical driven. And kind of what we're looking for there is what I'd call statistics that reach a washed out level. The VIX, we call that the stock market's fear index. It spiked above 40. That's a pretty good indicator of a market bottom. The put-call ratio, people sort of buying downside protection versus upside positioning in the market, reached a little over 1. You'd kind of like to see that number at 1.2. The percent of stocks trading above their 200 daily moving average dropped to 19.8%. Anything below 20% kind of implies we're getting pretty exhaustive in our selling. And then the other thing that I think is really important in this is the 200 weekly moving average of the market, which is at 46.75 held. That's a pretty important line in the sand for the technical people. They'd actually tell you what they'd really like to see is the market kind of undercut the previous low, bounce off that, and then we head upward. You kind of take it for what it's worth. I like the technical stuff because it gives me an ability to have a process. But sometimes you're like, oh, is it more sort of voodoo than anything else from that perspective? But we're using data. Yeah. And in these environments, the biggest thing I believe is you must have a process.
Yeah. And that's what you do, is to give people that process, let them know how you're working through it. It helps people to get a little knowledge from you and say, it's going to be fine. Here's what we're going to do. Here's our strategies. But I bet you've fielded a few anxious calls over the last few weeks.
Yeah, we have. And then on the other side of it, so you have your anxious people, and we understand that. And then you've got the others who are kind of looking for the time to buy.
Yeah.
And that's a challenging one as well. But once again, let's kind of look at forward-looking probability of success. I'm not sure if we're out of the woods yet with this 90-day pause. That's maybe changed over the weekend. The tariffs on China so China's about 14% of all imports. And if you look at where the tariffs were as we entered the weekend, that would still mean our effective tariff rate is going to about 22.5%, up from about 2% today. So that's still a big number. Yeah. We just saw over the weekend some concessions on semiconductors and phone parts. So that's probably why the market's opening up today as well. But let's look at your kind of time horizon and decline. So we were kind of sitting at a 17% decline at the trough. The kind of average decline in any given year is 14-ish. So we're below that. If you're thinking recession, typical recessionary market declines are at 24. So we're not there, but do you really want to bet on the next 7 per se? And then if we're talking severe recession, those can get us 30+% down. That seems very unlikely to me, not only the information I've been taking in, but do you want to make a policy decision that puts the economy into a recession, especially when we've got midterm elections coming up?
Probably not.
Probably not, yeah. And then, okay, what's our probability of success moving forward? So investing following 10, 15, and 20% declines and where do we sit a year later? In non-recessionary environments, if you invest down 10%, your average return, a forward-looking 12 months, 14%. If you invest 15% down, you're up 22%. If you invest 20% down, you're looking at a 24% return. So those are kind of averages, right? If we're talking recession, at the 10% level, you're probably still negative. At a 15% decline, you're maybe 7% higher the next year, and at a 20% decline, you're 10% higher. So our probability of success is fairly high. The other thing I was looking at is the average returns forward-looking, if you kind of like, is now a good time to buy. If we hit that, we're almost at that 20% threshold. If you're buying 20% down, 1 year later, you're looking up 15%. 2 years later, 30%, and 3 years later, up 34%. I mean,
yeah,
that's it. We kind of need to be brave, right?
That's right.
From that perspective. Yeah. So, and maybe March was a pretty good example of that. So I'll give you one statistic. The 23rd of March was the COVID low back in 2020. So we're 5 years later. We plummeted 34%, 23 trading days. If you were buying at the bottom, you're up 170%.
There you go.
It's time in the market, not timing the market.
Stick with Craig. It's going to work out in the end. We'll be just fine. Craig Popp, AccruWealth, AccruWealth.com, the website. Give us a phone number.
235-1416.
Craig, see you out on the golf course.
We'll see you there.